Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the founding partners of the Dividend Kings marketplace service on Seeking Alpha. This particular video is a subscriber request series. I've had several requests to cover a company, Synchrony Financial, and frankly, I wasn't really aware of this company. I didn't know who they were or what they were, but after doing a little bit of research, I discovered that first of all, it's an 85-year-old company that was primarily a part of General Electric. It was really their financial arm, I guess you would say, and then General Electric spun the company off, and the company has only been public since July of 2014. But it is an 85-year-old company. It does have a $21 billion market cap. It's not a small company. It's kind of got an interesting track record. Even though I have scant information, I do want to point out a couple of the characteristics that, at least at first glance, appear intriguing. First of all, the company is available right now at a blended PE of 7.47 times earnings. So that makes the valuation very low. Earnings yield 13.38%. And then, of course, dividend yield of 2.7%. And I do want you to notice that their dividend growth record has been very strong. The company increased their dividend from 2016 at 26 cents to 56 cents in 2017. Then it went to 72 cents in 2018. And then last year they paid 86 cents. And that's been almost a 50%, we'll call it round number, kind of average growth rate. Now, the company has underperformed the S&P 500 modestly on a capital appreciation basis and actually on a dividend income basis as well. But again, it's kind of early to say, and the company is significantly undervalued, and you might consider the market's overvalued. Now, it's the largest provider of private label credit cards in the United States. And one of the things that's happened here, I want you to notice the price hasn't really done much if you look at it from a high and low point of view over the years here since it's been publicly traded. And one of the things that's kind of kept the price down recently is they recently lost a huge contract with Walmart. It represented a significant portion of their credit card business. Walmart moved their business to Capital One, so that's something that's been kind of a negative, and I believe it's why analysts are expecting earnings to be down this coming year, but then analysts are forecasting growth again, so that's a positive, I guess you would say. So it is an opportunity to buy a very inexpensive stock with a long, legacy as an operating business. However, as a public company, we don't really have a whole lot of information. Now, as a result, I can't really look too well at things like operating cash flow. I can look at operating cash flow, but there's no analyst currently giving a forecast. So historically, the company's operating cash flow has covered their dividend at least these first 2 years. And the same is true of free cash flow. But once again, I don't really like to analyze companies like this when I don't have a lot of historical information to go by. But regardless, it's a BBB- rated company, which isn't really investment grade. It may become investment grade because of its history someday, but I guess part of that is because the financial firms haven't been able to look at it as a standalone company. The metrics, though, are interesting. It's got above market yield, not extremely high yield, but 2.7% is pretty attractive in today's environment. It's certainly available at a very low valuation and does offer a very high earnings yield. So let's look at forecasting a little bit, and I want to look at forecasting a couple of different ways. Number one is we are expecting a 9% drop in earnings, which I think has the company somewhat at a disadvantage. Now, the company has a short operating history, and so the analyst scorecard is rather short. They did have a big miss in 2017, and 2018 and 2019, their numbers were pretty good. So it's not bad, all considering. Their two-year forward forecast with a 20% margin of error has been spot on, but their 1 year forward, as I pointed out, has had the one miss there. So if I was looking at this from a normal multiple, now, again, I don't have a whole lot of data here, so I don't feel real comfortable talking about a historical multiple, other than to say that the market has valued this company at a discount to what I would normally consider a fair value for a company with 8% growth. And that's been its historical growth, including the forecast numbers we're looking at here for the next 3 years. So it has had decent growth. Started out poorly with actually negative growth at first, but then they started paying a dividend. Their payout ratio is very low. I want you to notice that I'm going to call it 20% for round numbers payout ratio. So that's attractive. There's room for the dividend to grow, assuming the company can maintain, their business results. Now, a couple of things about this company also that I really feel compelled to point out. And again, I'm ambivalent about this one. I'm not sure sure if I like it or not. One thing that's kind of a negative, their cost of goods sold have been increasing dramatically since 2015. It's been growing about 20% a year, and expenses, like firms like Morningstar and Zacks, I think especially, pointed out that they feel that that's a big red flag, at least, that that their costs or expenses keep increasing dramatically. Now, that's been somewhat tempered by revenues. They have been able to grow their revenues at over 9%, and they do generate an awful lot of revenue. So, from that point of view, maybe it's okay, and it's a matter of the company trying to find their way. Apparently, according to some of the research I've read so far, they don't have great technology, but switching costs for companies to leave and just the hassle of switching is very, very difficult. And another threat to this company might be the fact that there are other ways, for example, even on the phones, that companies are looking for ways to collect data. One of the advantages of a company like Synchrony issuing a credit card in the name of a company like, some of the retailers that the company works with, is that they offer a in-house card where you can only use the card at the retailer that the card is issued for, and then they have dual cards where they have partnerships with companies like Visa and MasterCard where they can issue additional cards. But, losing Walmart was a big blow, as I mentioned. And then there's also another issue. A lot of their business is related to retailers, and, they had Toys R Us file for bankruptcy, and JCPenney is one of their biggest partnerships. So, it's very difficult to get real excited about a company that's dealing in retailers like this and providing these retail cards. Now, these cards tend to last even after a retailer went bankrupt, especially if they're a dual card like a Visa or a MasterCard. But having said all that, I don't really feel strong that I'm an expert certainly in this company or its industry. I'm only starting my own research process. Long-term trendline forecasts are promising, but there aren't many analysts. There are 3 analysts reporting to FactSet that think it's going to grow at 9%. And if I check Yahoo estimates, there are a few more analysts following it from Reuters than there are with FactSet. They're looking at 11% growth. So again, that's a plus. So what we've got here is a very interesting company. It's not quite investment grade. It's only got a BBB plus rating. It's certainly trading at a discount to fair value, even at that 10 multiple that the market has been historically applying to the stock. So there are some reasons why this stock might be intriguing. It's certainly a big company. It's certainly a financially strong company. Their balance sheet appears to look, real attractive. They are involved in an industry that is very competitive, as I mentioned, and, they're also got kind of a concentrated business. According to Morningstar, their 5 largest card partners represent more than 50% of their total interest and fees on their loans and almost half of their loan receivables. So there are issues here and concerns that I think investors would need to focus on if they're really looking at taking a position. But the one thing that the company does offer is a compelling valuation. It is going to have some, issues coming up in 2020 with loss of the Walmart. That's put a crimp in the company's growth, at least temporarily, but hopefully they will be able to recover like the analysts are saying. But anyway, this is Synchrony Financial. I'm not a real expert in this stock. I want to emphasize that. But I did have several requests, very persistent requests, I might add, for subscribers wanting to look at it. So I did take a shot. I hope you found this of value. I would do my homework before I invested in this stock. And if you liked what you saw here, please subscribe to our YouTube channel. We'd appreciate it. And thanks for watching. This has been Chuck Carnevale saying talk to you again real soon.